On this episode of Curve Ahead, I am joined by Aeron Sullivan, the founder and CEO of Pangea Technology, a fintech company reinventing how money moves across borders, especially in emerging and frontier markets. From his days in the Marines to launching a nonprofit to now building a global foreign currency platform, Aeron shares how solving a problem at his last job turned into an ambitious startup mission. In this episode, we cover how Pangea is replacing outdated banking infrastructure with tech-first marketplace approach to currency exchange, and why growing too fast can be just as risky as growing too slow, and how Aeron's team is balancing discipline with ambition. If you're struggling to scale a complex system or finding product market fit, this episode is a crash course in building something from scratch in a broken industry. On today's episode of Curve Ahead, I am joined by co-founder and CEO of Pangea, Aeron Sullivan. Aeron, do you mind introducing yourself?
Yeah, sure. Hey, thanks for having me, Brian. Yeah, I'm Aeron, founded Pangea Technologies not quite 5 years ago. Before that, I was in nonprofits. Before that, another for-profit company that I had started. And before that, I was actually a Marine in the U.S. Marines. I'm married, 2 kids, live in San Diego, California.
That's awesome. So, you touched on your background a little bit. Tell me about your background and how that has led you to where we are now talking about Pangea.
Well, yeah, it's I think how founders come up with ideas are oftentimes even convoluted in our own mind. But more or less, I was actually at a nonprofit startup, and I say nonprofit startup because I think sometimes we think of nonprofits as being fundamentally different from for-profits. It's really just a tax status. It's not a business plan. So I was at a nonprofit called Bible Project. We create resources, not really for kids. They are animated, but they're more like explainer videos, educational resources for people that are interested in learning more about the Bible. Anyways, we had translation efforts around the world, and we were paying all these contractors in local currency. I also had friends that were like missionaries around the world that would tell me about these stories of like, oh yeah, I receive about this much every month, and it fluctuates 20%. I was like, oh, let's, put these two problems together. And I ultimately went out to the market for Bible Project to find a solution to that foreign currency related challenges, and was pretty woefully disappointed with the sophistication of the technology and the offerings out there. And so ultimately started Pangea to solve my own problem, and almost naively so. I was not from foreign currency. I hadn't been in fintech before. And so I was like, oh, I can do this. And yeah, we are doing it, but it was much harder than I had anticipated.
Now that we're talking about Pangea a little bit, can you kind of delve into super high level what it is that you guys do, who it is that you're servicing? You've established that you're in fintech, that you're doing foreign currency exchange, but can you elaborate, please?
Yeah. So, when we travel around the world as individuals, we don't necessarily think much of it. We, obviously are buying that cup of coffee in euros, or picking up that T-shirt, that souvenir in pounds. And when we swipe our credit card, the bank is more than happy to exchange that currency for us for a fee. But if you're a business or an organization operating internationally, you're doing that all the time. And if you don't do it smartly, you can end up overpaying a lot for those exchange rates. You can end up getting bit by the exchange rate fluctuating due to market volatility. And so really, if you're an international organization or company, you need a financial suite of tools that is pretty custom engineered for that international context. Now, to go one level deeper, Pangea specifically specializes in emerging and frontier markets. And so if you're now not just an international organization operating in all these different currencies, you're now operating in hard to reach places and financial structures and infrastructures that are maybe not up to par with what you might be accustomed to when you're just simply paying people in the US. So we operate all around the world, Africa, South America, Asia Pac, and really build tools to help organizations and companies manage their international currencies better. That's everything from managing risk to actually paying people, figuring out how to get money to certain places, things like that.
Yeah, I would think, especially in like emerging markets, that you would have hard times like finding partnerships with banks or what have you in order to either deliver funds or make sure that your services are executed the way that you expect it to.
Yeah, absolutely. Just, take, for example, like let's say you're paying somebody in Chad and Bank of America's like, what's their address? You're like, behind the farm field down this one road outside of this neighborhood. And they're like, well, We don't have that on, you can see it on Google Maps, but there's no real address, right? Things like that can actually, get it quite complicated. There's different routes. Sometimes you have to send funds through that. Nobody discloses this. It's like through trial and error, you discover this is how you get it there. So we've just been doing it long enough and well enough that we've figured out a lot of those hacks. But I think where we're maybe different from traditional providers is banks have been offering foreign currency services for a long time, even since the 1800s. Like, how do I pay for that oil shipment back in 1885? Well, you would use a bank that had a relationship with another bank. But it's always been service based, and that's why it's been pretty expensive. And so we've taken a much different technology first approach, which has required us to essentially like rebuild the infrastructure that powers foreign currency trading and payments from the ground up, and has allowed it to be a lot more efficient. So you'll never pay us more than 1% over the market rate for anything that we provide. And whereas like the average is 2.2 upwards of 7, depending on, what service you use. And really the difference there is because of our technology.
Are you able to elaborate a little bit more about the technology without kind of giving away your secrets?
Well, yeah, certainly. I mean, yeah, foreign currency is pretty confusing. So if anybody wants to try to copy what we've done, they're more than welcome to try. I wouldn't recommend getting the foreign currency industry. It's pretty challenging. So one way to think about what's innovative with what we do is actually from like a business plan or business method perspective, not even the technology itself. As I mentioned before, even since the 1800s, when you had to move money somewhere internationally, you had to use a bank that you had a local relationship with. And they would move money to another bank that they had some sort of agreement with in that other country. So you might bank with Wells Fargo, and Wells Fargo's like, well, I need to get money to London. You're like, well, they might go to JP Morgan Chase, who has a relationship with Barclays. And so now that money trades hands twice before ultimately to get to Barclays. That is still, surprisingly enough, basically how the entire foreign currency industry works worldwide. It's a lot of overlapping, intricate and redundant and inefficient relationship networks between correspondent banks in other countries. What we've done is really just leverage the digitization of finance systems as well as the connectivity of the internet. And so when you work with us, what we actually have found is, especially with emerging and frontier markets, is no one is great at everything, but typically a broker or non-bank financial institution or a bank is good at one or two things. And that tends to be regionally aligned. So if you want to get money to Kenya, then, Echo Bank or Equity Bank or Absa Bank in Kenya are going to be the best people to provide you Kenyan shilling and give you capabilities in Kenya. But I don't have a relationship with those three banks. So I go to Wells Fargo, who goes to JP Morgan Chase, who goes to Barclays, who goes to Echo Bank. What we've done is we have created a marketplace of providers that have access to certain countries or corridors around the world. And when you onboard with us, essentially what we do is we just go, well, if you're in these 4 regions, you need these 3 providers. And so we create an onboarding package. We actually onboard you with those 3 providers. But when you go to pay people, when you go to pay for bills, when you go to receive funds, we've done the work to route you to the most appropriate channel and send the information that you only have to manage in one place with us. And we repackage that and deliver it to that bank or that network in the way in which they're expecting to receive it. Because you might think that how you quote a currency is how they quote a currency, not necessarily. And so you can imagine having, if you're in 30 countries, you probably need no less than 8 to 10 bank or FX broker partners. Nobody wants that many bank logins and different processes that they have to manage. And so, really what we do is we are able to connect you to that marketplace. So just like when you order a bunch of different things on Amazon that are actually coming from a bunch of different manufacturers, but there's one type of return, there's one payment, there's one tracking system. We do the same thing, except the commodity that we sell or the goods that we sell are not packaged goods or household goods. It's currency liquidity and the ability to deliver those payments the last mile all around the world. Does that make sense?
I'm just trying to wrap my head around it. That it's so incredibly complex. There are so many just nuances to it. Like even just thinking, and you're in how many different countries that you're helping operate in?
We're pretty much in every country. So 150 plus countries. We can even get money to, Ukraine as long as it's not within 50 miles of the military zone. So yeah, unless there's like an economic sanction or something, we can pretty much get money there.
Just to think of like the complexities that are involved there is, and the fact that you've been able to establish that within 5 years is kind of insane in my mind.
It hasn't We've made a lot of mistakes. It's been a very challenging. When I first started, if you think of like starting an e-commerce business, you're like, well, there's Stripe. I can just connect to Stripe and I can process transactions. And even when Stripe got started, all they're really doing is layering a nice API, clean API connection for developers over existing payment gateways and payment rails. But in foreign currency, it's all over the counter, meaning that there's no centralized exchange with rules where people trade things. It all happens in the black box and the ether between banks. And in fact, it's really one of the only industries in the world that's not regulated. If you think who regulates money when it leaves a border and enters another border, I mean, really, it's just regulated within those borders. There's no international monetary system that governs foreign currency. And so we naively went into this thinking, okay, well, what infrastructure are we going to leverage to build this? And I'm like, oh, there isn't any infrastructure. It doesn't exist. And so, it cost twice as much money and took twice as long as we thought it was going to because we had to build it ourselves.
Does it also allow you a certain level of openness since there isn't really an infrastructure to be able to come in and be like, this is how we should build it to create efficiencies in these processes that hadn't previously existed?
I believe so. I think Swift is, you could think of it as a collaborative organization built by banks to make it easier for them to message payment instructions and tracking of payments around the world. But what it really was done, it was built to adapt and facilitate connections between old legacy infrastructures. It's almost an attempt to like modernize the legacy system. I would say that the current foreign currency industry has matured and iterated on itself as much as it possibly can. It actually needs to be replaced. At some point, you can't mod your car anymore, mod your computer anymore. At some point, you have to replace it with a fully new rebuilt system. And so that's really what we're doing. That's what we've been doing. That's what we're going to continue to do. Where our hope would be that in 10, 15 years, the way that money moves internationally is fundamentally done differently, and it's going to have to run on an entirely new type of infrastructure that's been built from the ground up for the modern digital era. So that's really what we're aiming to achieve. And so, yes, the long-winded answer to your question is yes. It does provide us a lot of freedom and the ability to connect a lot of different systems while not compromising the sort of complexity to the customer. And so, but building something that hasn't existed before from scratch is challenging nonetheless. And you still have to figure out a way to interop with that old legacy system too.
Other than the freedoms, what are some of conversely, what are some of the major constraints that you're facing other than the existing legacy systems?
We are a fintech. But as I mentioned before, really the most innovative thing about us is our business model, which is that marketplace model. And marketplaces have that classic problem of the chicken or the egg. Do you get supply first and then demand, or do you get demand first and then supply? And so for us, because we operate very differently, what we've really had to do is, as we acquire client base, they've got demand in a particular corridor or sector, and we go and we find partners that fill that sector. And once we have partners who fill that sector, we now have really good speed and or cost sort of advantages for that area. Well, then we can find more customers that need that corridor, but every one of our customers has some other corridors that they have. And as we see those expand, we then go and take that corridor. And so we've had to build that supply and demand back and forth, slowly and strategically. And so, unlike if we just served the same people that all of the banks already serve, so euro, pound, Canadian dollar. Sure, yeah, you can move really fast because everything trades online and everybody has digital access to it. And there's a lot of volume that moves between those countries. And you can move really fast. Can you be competitive long term? I'm not so sure. But because we've approached a different sector of the market, and we've been building that supply and demand, like I said, slowly and strategically, I think we have a much more defensible sort of perimeter to the business, because you can't just, to enter the market, you need to find a big chunk of supply or a big chunk of demand to get access, because ultimately, why would a bank want to do business with you from Africa unless you can make them money? Well, you have to have demand to make them money. And so I would say the biggest constraint to us is just the slow iterative process of building both sides of the marketplace at the same time. And there's really no way to do that. You can't shortcut that. You have to build the relationships, you have to build the supply, you have to build the customer base. Yeah.
Early on, when I first set out, I looked at building something that was more of a marketplace model and quickly realized that not only did I have to try to sell to one group of people, now I'm having to sell two, and who do I prioritize here? And in doing so, I kind of neglect both. So I pivoted away from that very quickly just
Hmm.
because I had that realization of, I mean, I struggle to sell one, I'm not going to sell two any easier.
Yeah, no, totally. We definitely have two customers. We like to say that we want more and more corridors. We want more and more providers. We've got 10 mouths to feed as it is, and so we have to bring all of that demand from our client base to those banks and non-bank providers, and they want volume. Otherwise, why are they spending the time working with you? So marketplaces are hard. We chose to do a marketplace. Marketplaces are hard anyways. I'd say especially hard in fintech. Yeah.
Tell me about some of the misconceptions that come along with FX.
Sure. There's some classic ones. It's not uncommon, and this might be more of a consumer thing too, but it's not uncommon that when you go to send money internationally, you see this wire fee. It's like international wire fee. And you might think like, that's the only fee that I pay. That's not the only fee that you pay. When you're trading one currency for another currency, you are effectively selling one asset class and buying another asset. So it's not any different than like when I go buy Apple stock or you buy Apple stock. Apple stock has a price in US dollars. Now, if I went to the London Stock Exchange, it might have a different price in pounds. The exchange rate is nothing more than something that's very similar. It is the price of one currency in another currency. And so well, how do I get that price? Well, how do you get the price of Apple stock? When you buy Apple stock, you're not buying it necessarily from somebody who is selling it. There is what we would call a market maker who is sitting behind the exchange. So the New York Stock Exchange has market makers. They're liquidity. We call them liquidity providers. They are there to buy the Apple stock the moment you want to sell it and then sell it back to somebody the moment that they want to buy it. And they do this rapidly all day in order to create liquidity for the market so people can buy and sell things, very quickly. And it's good. It reduces volatility. When, if every time you actually buy Apple stock or sell Apple stock, it'd be much more infrequent. And so the price would go up and down all the time. And so we want liquidity providers, but they don't do it for free. When they buy it from you, they're buying it for a little less than they know they can sell it. And when they sell it, they're selling it for a little bit more than they know that they're going to have to buy it. Foreign currency is the same way. The bank is marking up the price they receive to you. And that markup can be pretty extravagant at times, whole percentage points, multiple percentage points. And they can do that because there's really no competition. You're not at the New York Stock Exchange. There's not 8 liquidity providers competing to buy or sell Apple stock with you. You're going to the bank that you happen to be onboarded with or have a relationship with, and they're giving you a price and you're like, well, I'll probably take it. And so, in our model, you're able to compete your demand out to a much larger net or array of providers. And so that's really creating an exchange-like model for something that's really been pretty opaque. But yeah, let me stop there and just see if you have any questions on that. But that's probably one of the biggest misconceptions is like what you pay for foreign currency when you exchange it. It's not readily evident. It's very opaque. The wire fee is the least of your worries. That is the cheapest component of the entire process.
I think that's a great comparison, though, comparing it to like purchasing stock, because you are exchanging asset for asset. There are people on both sides helping you facilitate the transaction, and everybody takes a piece of what it is that you're trying to trade. So that, in my mind, makes complete sense. So
Yeah.
knowing that you're operating essentially around the world in every country, how does policy changes impact your ability to do business with or around the world?
Well, that's a good question. I mean, if you take like the recent tariffs as an example, policy changes like that are typically going to be either beneficial or destructive, or neither, but disruptive at least. Maybe it's not actually going to change a whole lot fundamentally, but it's disruptive. And so certainly, our clients get disrupted by things like that. We get disrupted by things like that. There's no really changing that. I would say that the major policy shifts that really fundamentally change how money moves and the relationship of a currency in relationship to another currency are monetary policy shifts. And so what that is it boils down to mostly interest rates. What are the interest rates of the countries that you're sending money to and from? And what are the capital, we would call them like capital constraints. So some countries say, hey, we're actually not going to allow you to take our currency out of the country. We don't want our currency to be traded outside the country. You can only trade our currency when you're doing bona fide business inside the country. And so if you've ever heard of like the term offshore, so there's like the Chinese, renminbi offshore, or the Indian rupee offshore. These are offshore markets that have been built up because the capital constraints inside the country kind of preclude investors, hedge funds, or businesses to bet on or against the currency, depending on what their underlying needs are of the business, or if they're a prop trading firm, what their view on the market is. So those monetary policy changes and those capital constraints can be really disruptive. I would say that this is a pure anecdote. I'd have to do the research to back it up, but anecdotally, I will say that countries that tend to have open capital policies tend to do a lot more trade with other countries. Nigeria has a very closed capital system. It's very difficult for people to do business with Nigeria, in fact, and it's very expensive to exchange the currency. Whereas Kenya, Uganda have very open capital policies, and we see a ton of volume and trade moving to and from Kenya and Uganda. And I think long term, I would say short term for organizations or people that operate in finance teams that are maybe listening to this podcast, it's really, I think if you're looking like, where do we expand next? Where are we going to set up our manufacturing facility? You really want to look at the monetary policies and the capital constraint systems within countries to help you determine like where best to probably set up. And you want to keep an eye on those. Long term, I think, we'll see those countries that have more open systems probably grow faster and in a more healthy way, letting the free market kind of do what it does.
I would think that makes sense, right? If you have a policy that welcomes foreign monies or allows your money to be traded outside of your own borders, that's going to help promote growth within your borders because people are more likely to do business with people who live there or want to facilitate business through that country.
Yeah, absolutely. We already have, the internet has been amazing at closing the physical divide between us, virtually. And so that's done a lot for international trade, a lot for especially services, industries, technology companies. But there's still a lot of friction in partnering together cross-border, time zone, language. And if you introduce sort of maybe at best very strict controls and at worst maybe authoritarian controls, you're just creating more friction that's going to, lead to less trade. And typically, more trade means more opportunity, which means more wage growth, more middle classing, and better governance. So yeah, that's really one of the goals of our organization is if we can make it easier to if we can remove friction from international markets, it should encourage more trade. It should encourage more collaboration. It should encourage more labor growth, wage growth, and middle classing. So, we are using a for-profit capital model to solve what is largely a socioeconomic challenge, but I think it's the best model to do it. I don't think it's going to be done by government collaboration. I think the selfish interests of businesses and individuals can actually be beneficial for everybody when they're properly aligned.
Disagree with that, but it's a very complicated statement.
Yes, it is. Yeah, complicated to do too.
So let me ask you this: what is Pangea's biggest challenge right now within the next 12 to 24 months, and like what steps are you putting in place to overcome that?
Yeah, well, I would say that our biggest challenge is managing the sort of growth cycle. And so, I like to think of like growing an organization as a bit like rolling a boulder up a hill. You need enough momentum so that the boulder doesn't stop and then roll back and crush you. But you also can't get too much momentum where you actually let it go and it rolls up too far and it comes back and crushes you. There's like a very fine balance in growing an organization where like you have a demand, you have new industries or target markets, you've got new features you want to build. You've got to invest in the growth and the infrastructure and capacity to actually receive that growth. But if you overinvest, you're going to run dry on capital, or you're going to sell a lot of the company to fund that. So certainly our biggest challenge right now is growing fast enough, but not growing too fast. And so that means you have to bet on the right places. You need to know where your infrastructure or personnel need to be shored up the most, but you can't get out over your skis. I think we've seen the, especially in 21, 22, 23, we've seen the outcomes of, the VC market pumping startups full of a lot of cash where you're then a little undisciplined and you get out over your skis and then everything comes crashing down, including companies and returns. And so, steady, healthy, responsible growth, but still ambitious and aggressive growth, trying to balance on those two things is really hard, but that's where we are now. I don't see that changing in the next, 2 years.
So you're trying to control that flywheel, right? Like you're gaining momentum, but you don't want it to overcome you as you're seeing the momentum, right? Like you're trying to be in a controlled expansion burn pattern.
Yeah, absolutely. Yeah. It's nice to have the luxury of a lot of cash, but even when you take a lot of cash and maybe you don't feel like you have, you can kind of push really hard. Well, you're creating a lot of expectations for investors as well, and they're going to expect to see a return on that. And so, I think I'm not sure if this has happened before. The thousands, we had the .com bubble. The post-COVID, we had a pretty large early stage startup bubble, and so we've seen a few bubbles burst. And I'm wondering if we finally have learned our lesson as to like how early stage companies should grow more responsibly, not growth at any cost, but also that early stage companies do require capital to grow. If you're reinventing a system, if you're building a new rocket engine, if you're building a new type of vehicle, that's going to take investment in order to see it through. I think aligning investors and capital and founders and companies is something that we could get a lot better at. And we've seen good examples of how it shouldn't work and how it doesn't work. But I'm hoping, maybe we're getting closer.
It's weird. The VC market right now, the investment, 2020 cash was cheap. Like you saw a lot of VCs dumping tons of cash into startups. I don't know where some of them are now, right? But like as a VC, you only plan on hitting a home run like once in 100 opportunities. So it's not like it's about diversifying the portfolio, but making sure that you have at least one winner in the bigger lot. So, I mean, it'll be interesting to kind of see I've noticed that there's been a contraction over the last year or two with funding. It'll be interesting how that continues to trend in 25, 26.
Yeah, I'm not sure, but we certainly felt the constraint on the early stage financial system over the last year and a half. I think we've almost run out of money like 42 times, but somehow we've managed to make it out alive. And it is getting better right now. But man, startups are hard. Being a founder is hard, and by extension, being a VC and picking the right winners is hard. It's a hard market to be successful in.
I mean, all of it comes with its uncertainty, right? But I think that part of what it is that we do is try to measure that risk and reward and making sure that we are risk averse in the right ways to make sure that we're trying to grow properly or put a product to market that actually has product market fit without just going and burning a bunch of capital to try to test it.
Yeah. If you can, I think that's probably one of the mistakes that we made early on is I think we had the impression that we needed to grow at a certain speed to kind of meet the VC targets. And so we actually went to market in the current market, in the client base that we're in, and it was working, but it was moving slow. And so we thought maybe we need to pivot, and we probably wasted 3 months testing other markets and things like that, when really we just needed to spend more time in our current go-to-market strategy. Because once you find product market fit, you can ideally increase the amount of leads, the amount of deals. But if you're just testing and experimenting, you might waste a lot of money in the process. I think, companies that can find product market fit, even with just a small number of clients early, and you find clients that are really, really loyal, that growth will come naturally. And just adding money to it will make it, accelerate it. But you should be able to do it without money. Money should be a shortcut to time, not to actually product market fit, if that makes sense.
Yeah, agree 100%. I think that in addition to loyalty, you want your early clients to be able to have that clear line of communication. Be like, hey, what is and isn't working, and help us help you guys. Getting that customer feedback to ensure that you continue to have product market fit versus someone else who is new to the market and may overcome that challenge already, making sure that you're getting that pivotal feedback early on to make sure that you're continuing to deliver what your customers expect.
Yeah, right. And not having a customer base that's so big, you can't manually sort of solve the problems that will naturally arise. So there's challenges we've had that I'm like, well, I'm glad we don't have 1,000 clients on the platform. I'm glad it's a manageable number because I know them, I can communicate with them, I can fix the issues, we can smooth things over. And by the time you actually do get to that large number, you've kind of worked out the kinks, but they will come. And so, and that's kind of the thing is there's really no substitute to that whole process other than time. Even if you have the money, you still need the time to figure those things out, or you end up with, a system that you built early on that got a lot of growth, and now it's large and unwieldy and it's unmanageable. And maybe you grew to 100 million in revenue really fast, but you're going to have a real hard time 10xing because your system is very burdened with activity and you can't fix it.
Well, it's not necessarily just activity. It could be something more technical like code debt that like you've now built code on parts, building blocks in your backend system that aren't can't be supported going forward and you have to code around it. So like there's a lot of other things to take into consideration when building fast.
Percent. Yeah, 100%. Yeah, I actually just spent the last 9 months with our engineering team. I took over engineering about 9 months ago and have completely refactored and rebuilt the core engine behind what we do. And, we went from, you can just imagine 100,000 lines of code spread across 50 files to 5,000 lines of code spread across 8 files. And they do the same thing. It does the same thing. It's just, but we learn from our mistakes and we understand what's actually essential, the best way to do it. And so now, gosh, if I added 100 clients in a month, last month, I'd be pretty worried. If I did now, I'm not worried because I understand how the system operates. It's clean, it's manageable. It's even just comprehensible by an engineer, But yeah, you got to give it time to figure that stuff out.
Yep. Well, Aeron, you've been a fantastic guest. So at the end of each one of my shows, I give my guests 90 seconds to plug anything that they're passionate about. So for you, it could be Pangea, it could be anything else. Without further ado, the next 90 seconds yours.
Yeah, thanks, Brian. Well, I'm not sure what the makeup of the audience looks like here, but if you happen to be operating in an international organization, leading an international organization, whether it be an NGO, a nonprofit, a for-profit, and you are finding yourself operating in emerging markets, I could almost guarantee that Pangea would be able to significantly help you both in saving capital and saving time, and especially saving energy. So you can go to pangea.io to learn more about us, or you feel free to even email me at Aeron, that's AERON, at pangea.io. I'd love to talk to you.
Aeron, thanks again.
Thanks, Brian.